Imagine this is only like a few weeks, right? A few weeks, maybe a month worth of yield. Imagine 2 months, 3 months, 6 months of yield. At this rate, you'd be at 1626. Eventually, this will be in a profit, in a nice profit. All right, welcome everybody. Welcome to my channel, The Financial Trader's Mindset. So in this video, what I'm going to talk about is what I'm doing currently in this market with concentrated liquidity, with Uniswap V3 concentrated liquidity pools. I'm going to go over my strategy, what I've done in the past, how I view the markets, and how I position myself for the best opportunities. All right, so what you're seeing here is a vault that I run for my members. It's a non-custodial vault, which means that you can deposit crypto into this vault, but you maintain custody, right? You can pull out the crypto at any time. I never have full access to it, right? So what this is, it's kind of like I look at it as kind of like an ETF, right? You drop crypto in here, it's like an ETF, and the strategy is run inside that vault. You can have your crypto in this vault, and every transaction within the vault is not seen as like a trade, right? Like the trade itself is when you deposit into the vault and when you redeem and like exit the vault, right? So it's two trades, entrance and an exit. And whatever happens inside is the strategy that's run inside that vault, if that makes sense, right? So anyways, I run this for my members. And if you're interested in checking out the vault or have questions about it, you can join my Discord below. And if you're interested in joining the vault, I do require purchasing my course. It's my course on Uniswap V3, concentrated liquidity, link in the description. I go over proper pool structuring, avoiding pitfalls, the mindset of liquidity providers, how to structure your trades, how to forecast your liquidity pools, and even how to plan out liquidity pools 2, 3, 4, even 10 steps ahead if you wanted to, right? Because the more you plan out and the more the more you plan out your liquidity pools, the better, because you remove emotion when you put in automation, right? If you have automation, the more automation you have in your process, the less emotion and the less knee-jerk reactions you'll have in your positioning, right? It helps you keep a level head. You know exactly what to do, when to do it, right? So there's no question of change in that, right? Unless there's some sort of black swan, right? There's always exceptions, but for the most part, it removes those knee-jerk reactions. Anyways, so here's the vault, and I'm going to show you a couple of strategies that I ran where I either minimized impermanent loss or even created what I like to call an impermanent gain. You create a positioning where you're in position to gain more than where you initially staked. See, impermanent loss is where, say, like you stake a liquidity pool on Ethereum at, say, $2,000 Ethereum price. Price is oscillating, moving around. And as you rebalance, you have to track that rebalancing to be able to at least break even at 2,000 when price oscillates back and forth, to incur a neutral exposure to impermanent loss. As price oscillates, every time you rebalance, if you're not tracking that initial, I like to call it the anchor. It's like an anchor, like that $2,000 price point is an anchor showing exactly what the value of your initial pool was and what your current pool would be valued if it gets back to that price, right? Impermanent loss gets a bad rap, and it's actually a tool. It's actually a feature with liquidity pools. It's a way to mitigate risk, and not a lot of people understand that. So here is the vaults that I run for my members. I know I keep touching on this, but here we go. So this is the performance of the vault. As you can see, all time, right? It shows infinity. I don't know why, but here in the past year, up 45%. Most of that was in the past, few months since the market started running, right? In August, the pool or the vault just kind of went, during this run right here. I actually sold or went flat in the vault primarily in August. And reason being is because market was just sideways. And by the time we got to this run here, the volatility was so low. There was like zero price action. And when that happens, volatility gets low. You're not making as much yield as you want. I was seeing like on Ethereum, USDC pools, I was seeing like 13, 15% APR. And I was like, well, it's not worth farming this for the risk of something like this, right? Because if price falls, right, you didn't make enough during this sideways action to be able to overcome this, right? And so I made the decision to take off the liquidity or to go flat in the vault. This came and then this kind of trended sideways. And I'm like, okay, we're kind of coming into support here. And I started putting on another single-sided liquidity pool from around 1,600 to 1,300. And I decided to start taking on a long position. And then we had this move up, right? So what I did is from here, as the market moved up and kind of reclaimed this level of 2,000, and as Bitcoin was ripping, obviously, I went ahead and set up a loan, right? So what I did was I lent out my Ethereum, which you see here, and I borrowed USDC. Now you're asking, well, why would you do that? Well, what I'm doing here is that I'm maintaining a long position in Ethereum. And then what I use this USDC for is to farm yields, right? Like say in this USDC Aave, I've been farming this for like 2 days, right? And the liquidity pools in the altcoins have been phenomenal. Now here I'm going to show you, right? So here's an example of a position that I ran almost a year ago, right? 8 months ago. But this is where I show like how you can avoid impermanent loss, right? So I'm going to get to the point really soon, right? So here you can see that in the quoted thread, I made 12,000 in profit, over 12,000 in profit. 7,200 of that was in yield, and that was in a few weeks, right? Now, $5,550 in appreciation. What is that? That is the impermanent gain. Now you're like, okay, what is that impermanent gain? And I started farming this at a starting price of 1,761 ETH. And then the current price was $18.99, right? So at that price, like $140 almost higher than where I started, I had a $5,500 gain in just the LP value, right? So that's what I call the impermanent gain, because that does not account for the yield that I earned. So in February 2023, I was farming this, right? 1,700-ish, pretty much the top right here. I staked the liquidity. So this was my initial stake price up here, right? And as price drew down and fell, I was constantly rebalancing, right? So if you go here and you can see the initial range was $14.99 to $17.50, right? At a $16.95 ETH price. Price went down. I had to rebalance and re-range when ETH hit 1,500. So I re-ranged to this new range, 1,400 to 1,850. Now you're thinking, okay, this is where you're incurring the impermanent loss. I rebalanced again to a new range. When price hit 1,400, I went to a $12.99 to $19.50 range. Price went back to 1,700. I recouped all impermanent loss, and then I earned a shit ton of yield, right? So that plays into this here, this total. So total profit, the shit ton of yield, and this is the impermanent gain, right? So I recouped all the impermanent loss plus had a gain on this particular sequence, right? It lasted a few weeks. And this usually doesn't happen as fast, right? Usually this takes months to play out. And a lot of liquidity providers, they start losing track of what their initial stake price, their anchor, and they start losing track of where the liquidity pool is at, and right, and they're just farming the yield, and they're just kind of mindlessly farming, and then they just, do not even realize how much impermanent loss they're locking in, right? So it's very important to track. You got to track. Compared to a hodler at a price, here's a starting price where they initially bought, say a hodler just bought Ethereum with the same structure as my liquidity pool, right? But they just didn't put it in a liquidity pool. Current price at $18.99. The value from when they bought, and then this is the value at the time, $18.99, right? So they gained over $8,200 in profit. That's pretty good, right? But when price drew down, this was around the low. They drew down $8,100, right? But they got paid no yield to do that. They're just holding Ethereum, right? They're just holding and just waiting and just pretty much hoping that it comes back up, right? Now here I compare it to my Uniswap V3 concentrated liquidity pool. Compared to them, they only earned $8,200, but here I earned over almost $22,000 in profit. 12,000 of it was in yield, right? And then 9,100, over 9,100 was in price appreciation of the liquidity pool. This $925 is the gain that I incurred from the drawdown when we were at our low, right? As I stated up here, it was like 1626, right? And when I rebalanced, I gained 925 when we got back to our starting price. So the increase in my liquidity pool was $925 when we got back to the stake price. So this all comes down to properly structuring your pools. Now you're probably wondering, okay, well, you have all this impermanent gain, you have all this yield, so why even hodl anything? Why not just do this? Well, there are drawbacks, right? There are larger drawdowns. You can see here at 1626, I had a loss of $19,900, almost $20,000 in loss. Compared to the hodler, they only had $8,100 in a loss. So you're like, oh, okay, well, I might as well just hodl then. But I'm not taking into account the yield that I've earned during that time, right? So I've earned $12,000 in yield, over almost $13,000. So let's just say there's a $7,000 loss there now with this yield accounted for. Say if price stayed at 1626. Now you add the yield to this almost $20,000 figure. Now I'm only at a $7,000 loss. The hodler has a larger drawdown. Now now this is where time works in your favor, because you don't, as a liquidity provider, you should not be worried. As long as it's in your plan, your trade plan, you're accounting for this move, shouldn't matter. You actually want more time in the chop, right? You want it to chop sideways for longer, right? Because what this does is that every day, 24 hours a day, 365 days a year, you are chipping away at this loss. And what you're doing is you're reducing your cost basis. So as this yield generates, this isn't your cost basis anymore. It's lowering day by day, hour by hour, minute by minute as this trades. So imagine this is only like a few weeks, right? A few weeks, maybe a month worth of yield. Imagine 2 months, 3 months, 6 months of yield. At this rate, you'd be at 1626. Eventually, this will be in a profit, in a nice profit, and you would lower your cost basis from 1761 to 1600, 1500, 1400, right? As time goes on. So you think about it, you're like, you're generating these yields and you're lowering cost basis. And that's what trading is about. Like when you're investing and trading in the markets, the whole idea is to lower your cost basis over time. And this does exactly that. And then not only that, but on top of that, I am positioning myself with a proper pool structure to be able to have the impermanent gain and take part in the appreciation of the asset as it moved back up to 1899. All right, but I'm going to pause it there, and you can check out the article for yourself. You can check all this out. I have the NFTs for proof showing exactly my positioning here, right? NFT IDs. You know, you can see these graphics here, the profit and loss, and you could really see the breakdown. Like I show it all. It's all there for you to check out, right? And you can vet it yourself as well. So there's all that right there, right? So going back to the vault, this is my strategy now, right? This is what I'm doing now is I am staying long Ethereum, right? Right here. I lent it out. And what I'm doing is I'm generating alpha on top of my long position. So yes, this is riskier because now you have a loan that you're farming liquidity with, right? Because, you know, if the markets draw down, right, the drawdowns will be more pronounced because now I have an extra $70,000 of exposure in this market, right? So there's more exposure, more risk, but I'm staying long this market, right? Staying long the market and farming liquidity to generate yields on top of this, right? So I started this particular strategy it was around November. I started it early November. I parked my spot Ethereum, borrowed USDC, and I've just been farming it, farming the yield and paying off the yield as quickly as possible because I'm also paying interest on this loan, right? So the yields I'm generating are averaging between 100, 200% APRs. Sometimes I see a 500% APR, 1,000% APR, depending on where the market is and how I structure my pools. But it's accounting, the amount of yields I'm getting is way more than what I'm paying in interest, right? I'm paying about 10 to 20% in interest APR. So on 70K, you know, that's about $7,000 to $14,000 a year. And as long as I make more than that, I'm fine, which I have been. And I've been averaging the past few months about 8 to 10% returns in a month in yield, right? So it's already been almost 3 months. So I've paid off. If I maintain this loan as it is at 70K, I've already paid off the interest, right? So all this is profit on top of it, right? The big one was Link. And I started farming it in November. And say like someone that bought Link up here, they're now just in profit, right? Whereas when I was farming Link, I was in profit, you know, for the last few months because I've been farming that yield and generating income, you know, while the market trades sideways. And the volume has been great. As you can see here, volume is good. Volatility is there. The yields are high. This is the time to be really farming those yields, right? And it's great because this market has been bullish. So dips have been bought, right? You're generating yields and you just keep doing it until the wheels fall off, right? Once the market structure changes, you got to get protective, right? And I'm very aware of that. You know, this is not going to last forever, but in the meantime, it's working. Right? It's working until it doesn't, right? Once it doesn't and the market tells me that it's going to fail, that's when it's time to take it off, look at a different strategy, maybe get more protective, you know, maybe do more of a, you know, single-sided liquidity, or maybe even go to delta hedging if things get bad, right? So, and then that's how you keep yourself, use these tools to keep yourself in the market and you continue to generate yields. You know, a lot of liquidity providers, They like to sit out the market when things get scary, but then they jump in when the market is like ripping and roaring. It's like, well, as a liquidity provider, you actually want to be in the market when it's uncertain and it's actually scary. That's the best time to be in the market. That is the best business for liquidity providers, is when there's fear in the market or uncertainty, because it generates a lot of volume while also not running away from you, because it's very hard to farm a liquidity pool when the markets are going up like this. You know, you're incurring a lot of impermanent loss. You're constantly buying at the top, keep buying, right? And you're not generating the yields that you want because you're constantly chasing that the price, right? Is just running away and then waiting until it finally like settles down and trades sideways, and then you could generate this yield. So yeah, so that's my kind of strategy in a nutshell. If you want to learn more, join my Discord, link in the description. My course is in the description. If you're serious about farming concentrated liquidity and you want to generate some high yields, you know, I highly suggest it, you know, because I've been generating a lot of yields and it's been really good. And I post all my liquidity pools in the Discord. You can see all my positioning, everything. That's for the members that join, right? So, but for free, you can join for free and ask questions. If you have questions, if you want more clarification on what concentrated liquidity is, how it can fit into your strategy, more than happy to answer that or field those questions. So, this video is getting a little long. I'm going to end it right there. But thank you for watching. Check out the links in the description. I'll have the links to this as well. So you can check out all this as well and see how exactly I negated impermanent loss and created an impermanent gain right there. And I created an impermanent gain. Where is it? Right here, you know? So it's really important to understand how this works. But the best time to learn is today, right? And, you know, just get in the saddle, because like they say, you know, just time in the market, not trying to time the market, right? You just stay in the market, generate yields, generate income, let the market do the heavy lifting for you, right? You don't have to sit there every day and, you know, and fiddle with it, right? Because they say that the most successful and profitable investors are those that have passed away. Dead people have the best performance in their portfolios. That's because they don't touch it anymore. So the more you can just sit in the market, just let the market do the work, the better. Anyways, I'm kind of running on here, but thank you for watching. Please like and subscribe, and I'll see you guys on the next one. Thanks.